Do you want to start a thriving real estate career, but don't know where and how to start? Do you want to become a successful realtor or investor, but lack the required knowledge and skills? Gear yourself up with the best and actionable advice here on the Real Estate Rundown. Tune in as Shannon Robnett talks with industry veterans about all kinds of asset classes, market trends, challenges, management techniques, and success stories. Listen to informative discussions with valuable tips that will serve as the foundation for your incredible real estate venture. Now, here's your host, Shannon Robnett.
Hey, everybody. Welcome back to another episode of the Real Estate Rundown. Today, I've got the privilege of interviewing a friend of mine. You know, it's funny, you get to know people in the business, but you never really understand their story until you get to meet guys like Zdenek, who have really come from a background. And every time I talk to this guy, there's another facet of him that I find to be amazing, from his movie career to, you know, what he's doing in the past, what he's doing in the present, how he's the family that he's raising. But Chad, I want to welcome you to the show, and can't wait to get into the details with you.
Yeah, sounds good, Shannon. Super excited to be on here. I think you're one of the few guys that actually has more kids than me. So I'm not sure how much time we'll spend on that one, but you definitely got me beat there.
There you go. Well, so Chad, kind of give us a little bit of a rundown on where you started in real estate and where life's taken you, and what your W-2 or your entrepreneurial role, what part of that was played into that whole deal?
Sure. So yeah, I definitely have had a meandering path, and I'll give you the nickel tour on that. So technically, I started out as a rocket scientist working as a structural dynamics engineer for Rocketdyne on the space shuttle main engines, and did that for 7 years before starting a business with my brother, which was a lighting business. And started basically from nothing while I was getting my MBA. Used his company as kind of a pet project. He recruited me over to be a partner with him and help grow and scale that business. We grew that to be employ about 75 people and have 3 different warehouses in about 15 years. And then he bought me out of that business in 2018, and I went into real estate full time. I like to say going back to real estate because I was in construction management and structural engineering before that, but went back into real estate as an investor and a syndicator in 2018 in multifamily, primarily here in Southern California, where I live, and then eventually started doing bigger deals out of state in the multifamily space and now self-storage space.
So, Chad, let's talk about that a little bit. You know, you've done some multifamily, you've done some industrial stuff, you've done some mini storage. Why are you involved in so many different types of deals?
Well, I think diversity is pretty important, especially, you know, in the dynamic market that we're in. We're filming this in April 2023. Is certainly a dynamic time to be involved in real estate. A lot of unknowns with interest rates, with what the Fed is going to do, with what you know, the banking industry, what's going on in the banking industry. So there's a lot of issues right now, and I think it's good to be diversified. I love real estate, so that's really where the bulk of my investments in time and money are. But you can diversify quite a bit within real estate, which is pretty attractive. And I know you've done a fair amount of that as well. So
yeah, listen, I was going to say that's a loaded question, man, because I'm very diversified. But you know, I think we can all agree that multifamily has been quite a bit oversold. You know, it's the only asset class that I'm currently seeing where cap rates are below interest rates. Right. It's actually trading at between a 4.5 and a 5.5, depending on the market you're in, on interest rates at 6. Right. And it's just boggling my mind that people keep piling in lemming after lemming after lemming on deals that are in this negative position. You know, we've got a ton of this stuff that's going to come up for renewal on a rewrite on the bridge debt or whatever else they had going on. And currently we're sitting on a lack of inventory, which keeps driving stuff, right? So there's this angst in the market about what are we going to do? How are we going to do it? But yet there's so much that is still trading, and, when you hear guys like Ken McElroy, who, $2 billion portfolio bought one deal last year, you wonder what everybody else sees in the market, So I can understand the pivot. And I was really setting you up for that because I knew you knew the answer. But, there's that pivot in the market where you've got to go to multiple classes to see what else there is. And real estate still has intrinsic value. It's still an asset in and of itself. You're just using maybe a different model or a different avenue. Tell me why you're looking at self-storage favorably in this market.
Sure. So as part of my diversification strategy is self-storage. And if you look back at 2008, 2010, self-storage was actually one of the best performing real estate asset classes out there. And it did really well during the 2008 recession. It barely felt a bump. So for your listeners who are worried about where the economy might be headed, or, are we really headed? Are we in a recession? It depends on how you qualify it these days. But certainly if you're worried about a recession, and if you think that history tends to rhyme, maybe not repeat, but at least rhyme, then that would lead you to self-storage because it did really well in 2008. So right now I'm working on a big deal in Texas in self-storage, 2,600 units. And I'm excited about that part of the market. So self-storage for me is a big part of the diversification play that I'm doing right now.
And I agree with you. I built several mini storage projects. I've seen where, a lot of markets get kind of saturated with owner users, or not owner users, but owner operators. Even with the number of kids we have, we don't need 2,600 units. But, there's a lot of people out there that they want this for their retirement. And so they do what they have in their retirement. They slow down, they get a mini storage, they operate that provides them with cash flow. But, that new thought process of, hey, you know what, these can be automated, these can be, run remotely. There's a lot of automation that goes into that. When you're looking at buying 2,600 units, what is your business plan moving forward to obviously bring more value to them and thereby bringing more value to your investors?
Sure. So if you look at, like I said, 2008 and how well self-storage did during that recession, that's one big positive. The other big positive is looking for where you might be able to provide value on certain properties. And if you look at the multifamily space, it's something like 90% owned by institutional owners at this point, which was not the case even 10 years ago. If you look at self-storage, only 25% of the market is owned by institutional owners. So 75% of the owners are, mom and pop, smaller operators that have had these properties for a long period of time. And for better or for worse, they're just run inefficiently at this point, right? There's a lot of technology that you can add into these properties. There's a lot of efficiencies that can be created if you take an institutional type approach and incorporate some of these technologies and improvements into these mom and pop run properties. And so that's what we're doing. And there just happens to be a lot of low-hanging fruit right now in this self-storage space because it's not overrun by institutional quality, high professional operator investors at this point.
So, but is that part of your plan, is to gather these units up, get them running better, and then exit to an institutional buyer, or are you guys planning a long-term hold on this?
So that really depends on where the interest rates are at in 5 years. So we secured 5-year fixed rate debt on this particular project we're talking about, and depending on where interest rates are at is going to dictate what our exit is. We do have multiple options at an exit. Ideally, if interest rates do come down and we create the value that we think we can create, we would refinance, return 100% of investors' equity, and hang on to the properties for passive income, creating what Ken McElroy, as you mentioned earlier, would be called infinite returns. That would be like plan A. If we can't do that, then we would most likely exit, maybe refinance, but that would probably be plan C. So we've got a few different options on how we would exit the project, which I think is really important when you're getting into a deal. It's good to have a lot of options on the exit, and those are some of the ones that we're looking at.
Yeah, speaking of exits, a lot of people right now are winding up in trouble because they got 3-year, 5-year debt. And here they are 3 years, 4 years, 5 years down the road, and it's not a favorable time to sell. What about that is, how are you guys safeguarding yourselves from that when you're looking at, okay, we're taking on 5-year debt. We're still in a climbing interest rate environment. We know that the Fed is going to continue for at least the short duration, but could it be as long as what happened in the late 70s, early 80s? What is the thought process behind that opportunity to exit on really just a 5-year debt?
I think the farther out you look, the more important it is to look at the macroeconomic side of things. And certainly we can look back to the late 70s, early 80s to see how we dealt with the high inflationary environment as a country back then. And I think the major difference between then and now is when we had, interest rates at 18, 19%, that was when our national debt payments were 25% of GDP, right? Which is manageable. GDP was much above what those interest rate, what the debt was. Today, we're at 125% of the debt. Our debt is 125% of the GDP, right? That's a big shift.
Yeah.
So the US cannot sustain high interest rates for a very long time. As of the recording of this, our interest rate payments are $1 trillion a year just to service the debt that we have. That's a completely different environment than we had in the 70s and 80s. And I think that's going to dictate monetary policy going forward at the macro level, that we can't get back up to 18%. We would literally collapse our economy. So if you subscribe to that, then you're looking out 5 years, you might be asking yourself, okay, where might we be? Personally, I don't think we're going to be anywhere near those interest rates. I think we're going to have lower interest rates. And if we didn't have interest rates, we got a lot bigger problems than having to sell a property at 5 cap or 7 cap or whatever it might be.
But let's run down that rabbit hole, Chad, since you opened up the hole here. So we're in a position, you're right, where we are the one that sets interest rates worldwide, because we are the default currency, or at least we were. That's rapidly changing. We've got Russia doing deals with India. That's the largest economy, the growing economy in the world. It's the only one that's still on the upside, both in growth of GDP and population. And yet you've got China and BRICS and all that kind of stuff going on. We could very easily lose our foothold as the world currency. If that happens, what do you think we're going to have as far as the ability to set interest rate policy, which is something that the U.S. has kind of been at the center of with the world banks and IMF and even the Federal Reserve has done that because we have been that reserve currency. But if we lose that status, what do you think is going to happen?
Well, I think that's a major risk that the U.S. faces right now, and I agree 100%. We're starting to see the erosion of the power of the U.S. dollar as the world reserve currency. I tend to believe it's going to be more of a death by 1,000 cuts. These kind of side deals that these countries are making, rather than just flip the switch off and move to a gold standard or central bank standard or something like that, or the Chinese yuan taking over. Like, I don't think it's going to be a flip the switch. I think it's going to be death by 1,000 cuts and having less and less influence on the world stage. That being said, if I'm able to put my money into a fixed asset that produces cash on fixed debt, I think that's a good investment, regardless of what happens on the world stage. So that's what we're trying to do. which by the way is not what everyone's doing. Some people say, hey, get into variable debt now because the interest rates are going to be forced to come down and you'll float it on the way down. Like some people think that.
Yeah,
For
the
me
only floaters we're
personally,
finding in that economic pool are the ones that are face down trying to breathe,
yeah,
and I mean, I completely agree with you. And, we both subscribe to the same thought process here. Your 3-bedroom, 2-bath house did not change. It did not morph and grow a third bathroom. It did not add a second floor. But if you really look at it, I remember a time that my dad had a conversation with my son, who was 16 at the time and had got his first job. And he was making $7.25 an hour, and he was pretty ecstatic, as you can imagine a young man would be. And he and my father sat down and compared when my dad got a job in his very first job in 1968, just to be clear. He was making $3.20 an hour, washing dishes at an Italian restaurant. My son was making $7.25, and my son went on to say, man, I'm making twice as much as you. But then I asked the question, but what could you buy? My dad could buy 11 gallons of gas, right? 30 cents a gallon. He could get 11 gallons of gas. My son at the time, 2010, 2, And so when we look at that, whether we're using 18% interest, whether we're using this, the biggest hedge against that inflation, which inflation is theft of the poor, theft of the working class. The best hedge against that is to get into something that is servicing its own debt, putting off some cash, but is also something that will translate back into dollars. We keep coming back to this currency because that's all we know, because we quit trading seashells and ox wheels and all these other things that we used to do thousands of years ago for something. So we got to this common currency called the US dollar. But when you look at it, if interest rates go to 18%, you've got fixed debt. If inflation gets out of control, you've got an asset. So people are willing to trade the wheelbarrow full of money so you'll get more dollars coming back out, thereby protecting yourself because your debt didn't increase. You have that fixed debt. So it's a very solid game plan, and I really agree with what you're doing there. I'm just asking, some of those questions because a lot of people are still wondering, well, isn't now a good time to be in cash? Isn't now, shouldn't I liquefy some of my assets that have liabilities attached to them as far as bank debt and get into a place where I can be more liquid so I've got dollars? And the argument you seem to be making that I completely agree with is you need to be asset rich right now because the asset has something of intrinsic value that will continue to go up regardless of what happens with the rest of the world and what happens with monetary policy.
Yeah, 100%. And I think your dad's story and your son's story is a really good example of really what's happening to purchasing power, right? Because that's really what we're talking about, where the rubber meets the road and strength of the dollar, where it meets Wall Street is what's your purchasing power. And the reason why the Fed is so aggressive on fighting this inflation beast is because they know that is one of the worst things for the US is losing its purchasing power. And that's been happening over time. And the Fed is okay with that at a rate of maybe 2% per year. But when we're, at 8% plus per year, 16%, if you go by the original CPI standards, that is a big erosion of purchasing power. So for me, I like to put that idle cash. Like, I disagree. I don't want to sit in cash right now. I'd rather put that cash into a cash producing asset that, by the way, when inflation continues to increase, so do my rents, or
Right.
so does my self-storage costs, right? Those are going
Right.
up with inflation, and so is my cash flow. So at least I can keep up with inflation at that point, and I don't have an erosion of my purchasing power because I'm already sitting on an asset, a cash producing asset.
Well, the other thing too, back to your self-storage strategy, aren't rents in self-storage month to month?
Yep.
So you have the most dynamic ability to adjust rents of any asset, because
Yep.
in industrial, you're looking at 3 to 5 year leases. In multifamily, you're doing 1 year leases. So when you get into an asset class like mini storage, you're doing 1 month leases. So, if you're not if you're not paid by the 5th, you're locked out by the 10th, you're auctioned by the 25th, or whatever the case may be, right? You're bada boom, bada bing, you're out. But as things deteriorate, if we wind up in a banana republic like Venezuela, where all of a sudden we've got 4,000% inflation, you're going to be the only guy that's going to be keeping up with the Joneses as far as, $9,000 a month for mini storage rent. And I like that number, by the way. I mean, that'd be fantastic, right? We got a 10 by 10, but it's $9,000 a month. So, Chad, let's talk about a little bit about why you've chosen real estate as your journey. I mean, look, you're a rocket scientist. I mean, I really actually know, actually, you're the second rocket scientist I know, but it's not the rocket scientist's fault that they know me, right? But when you've got this ability to do whatever you want, I mean, you've been in a couple of documentaries, you've been on some some movies, you're a rocket scientist, you've had an engineering firm. Why did you retire from a job to go into real estate? Help me understand that.
Yeah, so that's a good question. I have done quite a few different careers, as you mentioned there. And I'll tell you, I think I finally settled in on the golden goose here, primarily for two reasons. One is the advantage that you get with leverage with respect to real estate. You literally can borrow a lot of money to buy real estate, and you can't do that to buy stocks. Like, you're not going to get a loan to buy stocks. You're not going to get a loan to buy bonds. Right. You might get a loan to buy a business, but that's a totally different loan. So the lending that you have to buy real estate is really advantageous. The other thing you have is the tax advantages with respect to real estate, where you could shield a lot of your income through different strategies within real estate. So the more, as we know, the more money you can keep, the more money, the wealthier you're going to be. Yeah. So within real estate, you're able to shield a lot of that from taxes, which is why 90% of the world's millionaires have some form of their income coming from real estate. So for me, out of all the different things I've done, real estate, when you check those two big boxes, is a really great place to be. And that's why this will probably be my last stop. I'm happy to end up here.
Well, and when you get into the place where you can create recurring income while leveraging other people's money, do the job once, borrow other people's money to backfill a majority of the outlay, lock in, basically it's a forward purchase, right? They've stepped in as a bank. They're taking their position. All you got to do is keep making the payments for the next 10 or 20 years. Your asset's going to be free and clear. You're going to wind up in a situation where you're getting residual income. You've got tax benefits. I mean, all those things play a huge role. And it's, when you did your job as an engineer, you did the engineering once and you got paid, well, just once. It wasn't a situation where you did the engineering once and you got paid again and again and again. So, a lot of people can understand how that plays out, and that makes for a great career change, because you can do that and not have to be the guy on site every day. You're not, even in your entrepreneurial business, when you had the business with your brother, how many employees did you have?
75.
So you had the ability to leverage yourself, kind of like bank leverage, but, with an attitude. He had Larry over in cubicle 7 that was just not the guy, right? But you always had that stuff going on where you could leverage. But the minute you stopped driving the company, the minute you stopped bringing in new jobs, so the income, but the overhead didn't, right? And while you step into assets like real estate, you can definitely see where the income keeps coming in just because the asset is there, even if the asset is completely static and doesn't do anything, because people are using it. I love what Robert Kiyosaki says about having other people pay for your things, and taking that to the level that real estate does is really an exceptional end route around having to work, forever and always. And so I definitely agree with you on that. Where do you see, Chad, you guys are closing on your mini storage deal here shortly. You're going to be done with that very soon. But where do you see the next deal for you, and how are you sourcing your deals in the market that's as tumultuous as the one we are in?
Yeah, so that's a good question. For me, a big part of it is partnering with other people, because like I said, I'm doing out-of-state deals right now. I'm not the guy with the boots on the ground. So it's really important to establish relationships, get to know these other partners, leverage their expertise in the given markets to find out where are the good places to invest, what are the good sides of the street to buy in, those sort of things, which are really important details on a successful real estate deal. So I invest a lot of my time into these relationships and getting to know people and partnering with other people that have a complementary skill set that I do.
Yeah, well, and that's the funny thing that I've seen a lot of here in the real estate game is that you've got a lot of people that are able to put 4 and 5 and 6 people together that all have a specialty, that all come together with one common cause and are able to take down deals, make deals happen, really change the trajectory of it, because you've got a specialist in every area. You've got somebody that's a specialist on the finance side. You've got another specialist on the operation side. Maybe you've got somebody out there that's on the acquisition team that's scouting markets and turning over rocks like like nobody's business. And then you've got the capital raise portion of it. Why is it? I mean, I tend to see that you stay in the capital raise side of things. What is it about that's your superpower?
Yeah, and I have more recently been in the capital raising side of it. However, I don't really think that is my superpower. I think it's just kind of what I'm doing right now. Ultimately, I'd like to be more on the entrepreneurial operator side. My first deals I did, I was the solo GP, so I did not bring any partners. I was the only guy. I did everything from A to Z, and ran my own deals. More recently on these larger deals, I've been more on the capital raising side just because that's been kind of the need in the market. But ultimately, I'm really looking to partner with other people to create a business and get, really kind of leverage my entrepreneurial roots. I've started 6 different companies over my years, and that's really like what I think my superpower is growing and running a business. And I want to do that within the real estate space. So, ultimately, I think I still will be doing some level of capital raising, but certainly that's not my only strength. And ultimately, I want to do a bit more than that.
Yeah, and that's the amazing thing about real estate. There's so many facets to it. There's always more to learn. There's always more to do. There's always, another deal to do. Somebody asked me the other day, when are you going to quit? When am I going to stop doing deals? And I told him, I said, you know what? I hope I die with an LOI in my pocket. I really do, because there's no reason to stop doing deals. It's not like I'm out here digging a ditch, I mean, I watch it, I'm fascinated by other people digging ditches. Right. But that's not, anybody that knows me knows that I'm not going to stroke out on a job site. Right. But you do have that ability to then look at it and go, wow, this is an opportunity for me to grow, for me to bring a different skill set, everything like that. As we look at what's going on in 2023 with, the dollar changing and all those things, where are you seeing pricing going in, we get this question a lot, but isn't now a bad time to buy real estate? Aren't prices dropping in real estate? What's your answer to that question?
Look, I get really, really frustrated by this perspective from investors, right? They want to be on the sidelines right now. I want to stay in cash. I'm going to wait, blah, blah, blah. It's like when you got a 4th of July sale for a car, you buy a car. Like when the pot roast is on sale at the market, you buy a little bit more of the steaks in the market, right? When everything else goes on sale, you buy. When real estate's on sale, you sit on the sidelines. Like, why do people do that? I just got a $4 million discount on this deal, which, by the way, is got appraised $2.5 million higher than what we're buying at. So we got a $4 million discount, and people want to be on the sidelines because they're worried about it being on sale. Like Warren Buffett would totally disagree, right? When there's blood in the streets, be greedy, right? We know that saying. But it just doesn't resonate with investors for whatever reason. They want to sit on the sidelines. Meanwhile, the people that are actually doing deals, we're getting massive discounts that we would never have gotten a year from now. And in my opinion, we're not going to get a year later, right? I'm sorry, we got them a year ago. We would not have gotten them, and we're not going to get it a year from now. So this is like the sweet time to get some of these amazing deals, get really good discounts. Real estate's on sale. Buy,
Yeah.
buy. You want to marry the deal and you want to date the debt. I'll pay high debt right now because I know I can refinance it later if I need to, right? As long as it's
Right.
fixed. I do fix debt.
Yeah.
So I've got that advantage right now. And for me, I'm picking up these deals right now. I'm super aggressive on it and excited because I'm getting a lot of retrades. I'm getting a lot of discounts. And you know this as good as anybody. A year ago we were doing best and final offers, right? Like,
Right.
okay,
Right.
I'll give you another, 500K above asking because I really want the
Yeah.
deal. Right.
Yeah.
I mean, that was the
It
environment
was
we
just
were
how
in
deep
just
can
a
you
year
cut
ago.
yourself? How
Yeah.
how much can I get out of you? Okay, look, I've only got one kidney left. I can't give you two kidneys, I got
Yeah.
to keep one of
And,
them.
and now we're on the flip side of the coin right now. We're getting discounts from buyers. We're getting concessions. We're getting amazing deals right now. And yet you still have a lot of investors that aren't comfortable right now and they're sitting on the sidelines. And those are the lemmings that are going to be paying for the high increases a year from now when the people that understand about blood being in the streets, they're the ones that are actively buying. And that's what I'm doing.
Well, and they're the same people that got into Tesla at 800 that went to 900, and now they can't understand why it's fallen all the way back down. But, the thing that I look at too, Chad, is if the deal will cash flow from the beginning, if the deal makes sense today, if you don't need, I loved how you said it, look, our plan A is that, we hold this, we get some better debt later, but we have other plans because the reality is, if your deal can go the distance today, it can spit off cash right now today, give that to the investors, everybody wins. What's wrong with that deal, right?
Yeah.
I mean, you could do that deal. You've got 5 years, 4.5 years before you need to do anything with that deal. And at that time, you have choices where a lot of people are looking at it going, well, you know what? Prices are falling. And, it's funny because we look at statistically, looked at the MLS numbers around where I'm at in Boise, Idaho, and we have a 1.9 month supply of housing. Now that statistically tells you that we're low on inventory. The thing is, when you dig in deeper on that, anything under $500,000, 3-bedroom, 2-bath, 4-bedroom, 3-bath, whatever, anything under $500,000 is still in a multiple offer situation. It's the stuff that's $500,000 and over. The bigger stuff, the larger houses, the $1.5 million places, well, those are the people that could potentially lose their Silicon Valley job or whatever going on like that. They're the ones that are kind of holding off. But you're seeing that of that 1.9 month supply of inventory, 68% of that inventory is houses over 4,000 or over 3,000 square feet, right? So a little bit more than your starter family home. And those are the ones that are taking 1.9 months to sell, even in this market, right?
Mm-hmm.
So when you look at that, I mean, your analogy of when to buy and when to do it is exactly right, because we still have people that are looking at it going, man, now is a great time to buy a new single family home. It's a great time to invest in real estate as long as the deal is cash flowing, because we're not dealing with 2.4% interest rate and appreciation for days. And we've got some issues that are real life issues, like they've been for most of your investing career, most of my investing career, that this 2% interest rate wasn't real. And we were always going to get back to these. We were always going to come to the day that we sat here and went, yeah, that's 7%. I don't know what else you want. But then again, the other side is I'm looking at acquiring some industrial stuff that's a 7.5 cap. I'm actually going to make money, right? I'm still in the arbitrage situation. Instead of buying that thing at a 5.5 cap, I'm buying it at a 7.5 cap, which again reduces price. I might be paying a little bit more for the interest rate. Again, like you said, I can refi, I can do that later, or it cash flows right now. But the heat is out of the market. So instead of the realtors going, hey, I'm actually getting pricing on stuff, right? You remember, Chad, we weren't getting pricing 18 months ago. It was, send in your offer, call for offers. Guidance tells us, what guidance was? Guidance was the guy that got closest to the cliff. We just hand him the bucket of rocks as he went over, right? That's the guy that paid the most,
Yeah.
And you never wanted to be that guy. But here we are. We got prices back on things again. We've got deals that make sense. We've got due diligences that are back in place. We've got timelines that manage, and you look at guys that have been doing this for years, and we didn't get caught up in the hubbub of everything in the middle. There was a lot of deals that still got done in 20, 21, 22 that, even with the froth and the foam. But we're back in a place where real estate is being done based on numbers and common sense and things like that. And we still have decent debt. I mean, I was talking to somebody the other day and they were talking about what interest rates are in Peru. They're like 30%. You can't afford to finance in Peru at 30%. No. You wouldn't think. But then again, the deal would probably reflect that. So, when we're looking at how deals keep going, my camera's spazzing out. When we're looking at how deals keep going, I mean, it comes down to the fundamentals, right? It comes down to the fundamentals of how you underwrite it, how you're taking it down, how you're communicating with your seller about your price, my terms, what that looks like, getting things across the finish line. I still think there's going to be a robust real estate market for the next 2 or 3 years, don't you?
Yeah. I mean, look, I subscribe to the idea that real estate is the best get rich slowly scheme out there, right? I mean, whether you bought last year or this year, in 10 years, it's really not going to matter. So, debt is a big question mark. You gotta watch your debt, but I think you and I are both smart enough to do that. But going back to your idea on where we are historically, a 7% debt is like 40-year average, right? It's like, it's not bad debt. No. And if you have a cash producing asset at that fixed term debt, that's a win.
Yeah.
That's a win.
No,
and
I completely agree with you.
You and I, like you're the value add king, right? You're a development guy. So, but guys like you and I that are creating value, like long term, that's a win-win. There's no way around it. We're going to be winners on that.
Well, and especially when you're coming in, you're taking an asset that's maybe not managed to the potential. It's not got the add-ons. It's not got the automation, and you bring that technology to it. You're coming up, showing up, actually doing something. The last year and a half, all you had to do was buy the asset, hold your breath for 90 days, and you were able to make money on it. Mm-hmm. Now you're actually having to bring value to it. And there's a lot of people that don't understand you got to bring value. So they don't understand how to underwrite that value, how to bring that value. So, Chad, when you're looking at these out-of-state deals, and I know you've got a partnership group, are you jumping in alongside the guys that are operating and seeing how they're doing it? Or are you just trusting that they're doing it? How are you double checking your partners in situations like this?
So I think it depends on the partnership. So, and like I said, I've done everything from A to Z. So I'm kind of a chameleon in terms of what the partnership actually needs. Certainly you always have to do kind of the sanity checks and keep an eye on things, but I like to do quite a bit more than that as long as the GP team can use my help, and oftentimes they can. So I tend to get really involved in the value add side of things. As you know, I'm also a licensed general contractor. So the value add aspect of it with respect to construction, I'm pretty active in. And then on the asset management side, also very active in, depending on the deal. Sometimes you've got a really good GP team, and frankly, they don't need my help on that part of it. And that's okay. They don't need my help there. But on other teams, when they do need my help, I'm happy to step in, and I do a fair amount of work in that regard.
Awesome. Well, let's kind of wind this down on a personal note. Tell us a little bit more about, I've alluded to it several times, your acting career. Tell us a little bit about what you've done in that space.
Yeah, so I started out just happenstance. So I do live in Los Angeles, but that's not really, I guess that's not where I came from with respect to TV hosting and TV work. But I was auditioned for a gig as an engineering expert on a show. And this was only like maybe 12 years ago now. But I auditioned for the job, just was referred to it from some professors at my undergraduate institution, Loyola Marymount University. Applied, got it for that episode, and they wound up keeping me on for each episode. And then they wound up doing a second season and made me more like a co-host. And then that production company did another show, and they brought me on to co-host another show. And then I wound up getting a Hollywood agent to help represent me for different things. And it just kind of grew from there. And the last gig I did, I think you saw the episode, it was on the Smithsonian Channel and National Geographic, called Inside Mighty Machines. And we did, those were 1 hour episodes. I was the solo host on that show. just diving into giant machines to find out how they worked, and working with the contractors and demolition experts, which was a really cool show. And so that was the last one I did. So I've always kind of done it on the side, but I've gotten to see some really amazing things, amazing experiences, and it's been a fun side hustle.
Yeah, well, it's good work if you can get it right. Obviously, I got a face made for radio, but we still do these podcasts. So, Chad, tell everybody where they can grab more information about what you're doing and catch up with you.
Sure. So, our website's a good spot, CSQ, like Challenge Status Quo Properties.com, or any social media sites is just at CSQ Properties.
Awesome. Well, thanks again, Chad, for being on the Real Estate Rundown. And guys, thanks for tuning in. As always, like, subscribe where you get your podcast. Let us know what you think. And we'll catch you guys next time on the next episode of the Real Estate Rundown.
That's a wrap for today's episode of the Real Estate Rundown. Let these newfound strategies pave the way to start a successful career or a profound rebranding. If you loved everything you have heard, listen to more conversations at www.shannonrobnett.com. And be sure to leave a rating, share it with your friends, and subscribe. Until the next episode.